Now today I want to talk about the topic of whole life and term life insurances and share with you the facts and figures revolving around the use of both instruments to provide for your insurance needs. Now when it comes to comparing the whole life and term life insurances, I realized that a lot of people, even your insurance agents and financial advisors, do not actually do an apple-to-apple comparison between the two instrument classes. They often get it wrong in the areas of the duration of coverage or the return rate that they use for the calculation. Alright, when it comes to the duration of coverage, most people do not match the coverage duration of a term life plan to the duration of coverage for a whole life plan, and that results in a different basis of comparison. When it comes to the return rate, most people like to use a return rate of 8 to 12% a year, which oftentimes can only be achieved by an aggressive investment portfolio, instead of using an appropriate return rate that matches the risk level of a whole life insurances itself. Right? Once again, that results in a very different basis of comparison that is simply not fair. Now, when it comes to the use of whole life insurances today, they are really not 100% whole life, but in fact they are a hybrid of a whole life and a term life insurance. Allow me to explain. Typically, the structure of a modern whole life plan works like this, right? You have a base sum assured that provides you with an insurance coverage for a lifetime, and an additional sum assured that is on top of a base sum assured, which essentially expires at the age of your choice, usually at 70 or 85 years old. Now, for those who are sharp, you would have realized that actually the base sum assured is the whole life insurance component, while the additional sum assured is technically the term life insurance component. To do an accurate apple-to-apple comparison, what needs to be done is to design the term policies in a way where they reflect similar coverage behavior throughout the policy lifetime. Okay? To blatantly omit the effects of coverage beyond the age of 70 and say that buy term invest the rest as a clear winner is at best a display of a lack of knowledge towards basic financial concepts and at worst, outright misrepresentation, especially for those agents who try to use this pitch or strategy to push for an investment-linked policy, right? Now, having said that, let's establish our parameters for the purpose of this exercise. The profile of our case study, let's just call him Jonathan, will be a 25 years old male who is not a smoker and works in an admin job. Just like most of us, he has plans to retire at the age of 65, which means that beyond that, he will not receive an active income. Right? His annual budget for his insurance purchase is set at $3,000 a year, of which whatever that's left over will be used for investments. Now, in front of Jonathan today, he has two options. The first one is the use of a term life insurance, one that covers him till the age of 99, and the other term life insurance will cover him till the age of 70 years old, or he could just use a whole life insurance that essentially provides the same coverage behavior. Now, when it comes to each option, term life is obviously cheaper in the earlier years, but it will become more expensive beyond the age of 50 years old, as the whole life plan itself is usually payable for only 25 years. As a result of that, Jonathan would be able to invest more money that is left over from his $3,000 budget in his earlier years if he were to go with a term life insurance option. But take note that beyond the age of 65, after he has retired, he will have to draw down on his investments portfolio to finance and pay for his insurance premiums, as your term insurances are payable until you claim or until it expires. So how does this affect Jonathan's payout in the event of claim and his surrender value in the event where he wants to cancel the arrangement? With regards to the use of calculations for your whole life insurance option, I've took an average of both the values based on an estimate of 3% and 4.25% investment returns as based on how the insurance companies invest, as well as the theory and impact of reversion of mean. That is what you can expect to receive from an insurance company's investment performance over a long period of time. Okay? By taking an average of both values, we are also being realistic with ourselves instead of being too optimistic or pessimistic when it comes to the expectations of our investment returns that we can receive from the insurance companies itself. Now, having said that, let's take a look at the outcome. Based on a 2.5% annual rate of return, which is a conservative estimate, We see that the use of both a whole life insurance is evidently better in terms of the coverage beyond the age of 65 years old, as well as the surrender value is way better beyond the age of 45 years old, right? Please pause the video if you need more time to examine the graphs closely, yeah? Based on a 4% annual rate of return, which is, in my opinion, the most accurate basis of comparison in terms of the risk-adjusted return, we see that the use of a whole life plan is evidently better in terms of coverage beyond 70 years old and surrender value beyond age of 50 years old. Based on a 6% annual return, which is what you can expect by investing in a balanced portfolio, we see that the use of whole life and term life insurance is somewhat similar, right? That is for an apple-to-apple comparison. So what about an unfair comparison, right? What about just getting a term life insurance that covers till the age of 70 years old and investing the rest? Now, even though this is not a fair comparison, I felt that there's a need for us to run through some of the findings before making a conclusion between the use of these two instruments, since so many people are using this unfair comparison as a basis of recommendation. Now, based on a 2.5% annual rate of return, which is the conservative estimate, we see that the use of whole life insurance is evidently better in terms of coverage beyond the age of 70 years old, as well as surrender value beyond the age of 55 years old. Once again, please pause the video if you need more time to examine the graph closely. Based on a 4% annual rate of return, which is the more accurate basis of comparison in terms of risk-adjusted return, we see that the use of term life is very much similar with the use of whole life policies. Now, based on a 6% annual return, however, the use of term life is evidently better as compared to the use of whole life insurance, both in terms of the payout as well as the surrender value itself. In short, based on an apple-to-apple comparison, as well as an unfair comparison that most of us are used to, we are able to tell which instrument class is better quantitatively based on the following return rate assumptions. If we are to looking at a 2.5% return rate, the use of whole life plans is better for both the fair and the unfair comparison. If you are looking at 4% return rate, the use of a whole life plan is better for the fair comparison and neutral for an unfair comparison. If you are looking at 6% return rate, it is neutral for fair comparison, and obviously term life will be better for an unfair comparison. When it comes to the use of the return rate, I would suggest that you stick between 2.5% and 4% to base your decisions on, as those return rates are easily achievable without taking on more risk, as you can simply just contribute the amount into your CPF, as opposed to a return rate of 6 to 12% and above, because those return rate requires you to bear on higher level of risk, and there are practical limitations that may impede your ability to perform, right? So just stick to 2.5 and 4% return for a more fair comparison between the use of these two instruments itself. Now, personally, apart from just the quantitative factors alone, qualitatively speaking, I feel that the use of whole life plans are a better option to use as a foundation of your insurance portfolio, as they are simply just more flexible in terms of the coverage, right? Let me explain. Now, for whole life insurance coverage, or rather the coverage that you receive when you are working, it will serve as a means to replace your income. And when you retire, the insurance coverage that you receive will serve as an additional buffer that will help you transit to a different life stage should you suffer from a disability or a critical illness. Right? The reason why I say this is because many of times we forget that our lifestyle will change significantly when we suffer from a disability or a critical illness, which may result in hidden costs here and there, such as the need to renovate your house or the need to change your diet. Having this coverage beyond your retirement or beyond the age of 70 years old will help you address all these potential hidden costs that we may not have taken into consideration in the first place. Lastly, the whole life insurance coverage can also be taken into consideration as an asset for your legacy planning, which most of my clients will look into at the second half of their life. Right, so you see that the use of insurance coverage for the whole life insurance component is actually very flexible when you're working, when you've retired, or even upon your demise. right? On top of that, there are additional features such as your retrenchment benefits and non-forfeiture options, which I haven't even talked about when it comes to the use of whole life insurance policies, right? With regards to the use of a term life insurance as an insurance foundation, I'm not really a huge fan of it, and neither do I recommend it to most people, as number one, you have to take on higher risk and invest correctly for buy term invest the rest to work, right? Number two, the margin of error that you'll be working with is very low, as you simply cannot F up either your investment returns or your insurance planning, as that will cause the entire strategy itself to fail. Number three, you end up mixing both insurance and investments instead of separating it, as your whole strategy of buy term invest the rest is dependent on your investment performances in the first place, right? If your investments underperform, it will result in the failure of both your insurance and your investment plans. And like it or not, this will put unnecessary pressure on you, which may affect the quality of your investment decision, and that is something that you do not want to have, especially when it comes to investing, right? So all in all, the use of a whole life insurance is, in my opinion, a more suitable option for most people, as it is a more conservative way to structure your insurance portfolio. And it detaches the topic of insurance from the topic of investments, which allows you to tackle each component of your financial plans independently, right? Buy term invest the rest is a viable strategy only for those who really know what they're doing, of which, based on my experiences speaking to so many people over the years, it is really the minority of individuals that will do it correctly, right? Most of us will still be better off with a whole life plan rather than blindly taking on more risks to chase after returns, which may end up jeopardizing both your insurance and your investment plans. So that's all I have for the video today. If you'd like to find out how you can benefit by working with an independent financial advisor and a certified financial planner, you can reach out to me via my website. Do follow me on the following social media platforms as well to stay updated with future content, and you can always slide into my DMs anytime, as long as you have any questions. I'll be happy to help. So that's all. All the links that you see on the screen will be in the description below, and I hope to connect with you all soon.